Welcome back to the Real Estate 401k show. I'm your host, Mike Weinstein, alongside Justin Frederick and Ryan Gerdes. You're going to want to go ahead and text the word rates to 623-AZ-RECON. That's rates, R-A-T-E-S, to 623-AZ-RECON, because we are going to be talking about rates, what goes into rate improvements or bad news about rates, and where we stand right now. Now, Justin, obviously, this is going to be somewhat older news within the last week and a half. It always depends on when a listener is listening to the podcast. Sure. But within the last week and a half, we saw rates. I would say the word dramatically improved.
Dramatic is a good word for it.
Almost overnight, if not overnight, improved by between 0.5 point to 0.75 of a point. How does that happen? And how do we just wake up and rates are that much better?
Yeah, so we actually saw in our VA rates, we saw a full percent, which was pretty incredible. So what happens is when you start to get all this news that comes out, and we live in an era where social media and news, any type of media is just at everybody's fingertips, and it's blasting on your phone all the time. So consumer confidence plays a huge role in what happens and how rates are impacted, because it's impacted through mortgage-backed securities, 10-year Treasury notes, 2-year Treasury notes. Those are major pieces of impact, but the stock market also plays a role as well. As if you didn't notice, it was Friday the 3rd, I believe it was, or Friday the 2nd, August. The stock markets took a huge dump because the day before the BLS report came out, which basically is job openings, and job openings were well low. And if you guys didn't see the actual breakdown of the job openings, 2/3 of it was healthcare and education, which has no impact on the economy. We need those no matter what. So these other job openings, the other third, was not near enough to supply with a growing economy. So that hurts consumer confidence. The stock market was...
Is there a survey? Did someone call consumers and say, hey, how confident are you?
Yeah, no.
I just had 3 cocktails, sir, and I'm doing really good. I feel really confident.
It's really based on the news that comes out, and you just start seeing things move. The stock market, the securities, the treasury bonds. But prior to last Friday, it was August 1st that the Feds came out after their meeting. Actually, I think it was the 31st. They came out July 31st. And they said they were going to lower interest rates in September, almost for surely.
Fed rates,
mm-hmm. Which that rate will directly impact HELOCs, credit cards, things like that, revolving accounts.
But doesn't always reflect mortgage rates?
It does not. It does not. It will seep into mortgage rates, but it doesn't have a direct impact. Now, when people get scared, typically they take money out of a higher risk product and try to move it into something that's not going to move as much. So bonds, securities, things like that. So as that happens, you start to see rates get better. But all this talk with the Fed, they already started baking in, from what I understand, 3 different decreases to mortgage rates. So we're already seeing that getting baked into the 30-year fixed rate. We're seeing that all being impacted right now. Now, I'm really interested to see what happens the day that the Fed lowers the rate. I'd like it to see it move down a little bit more, but I have a feeling that we're just going to see business as normal that day. just because it's already kind of been baked in.
All right. If you have questions about interest rates and are curious to know where you stand, what rate you qualify for, or would love to have a conversation about building wealth in real estate, we encourage you to text the word rates to 623-AZ-RECON. That's rates to 623-AZ-RECON. Ryan, I think this is kind of interesting times because the general theory would be, okay, when rates come down, the buyer market is going to go crazy. I'm not so sure this
I don't
time
think that's gonna
around
happen.
because I think that with these recent rate decreases, and especially if we see one in September, for the savvy buyer or for the savvy investor, I think this is probably the best opportunity because yes, rates are going to go down, and even if they significantly go down, there's a lot of people that have just flat out will not do anything until after the elections,
Well, we've
and or fear of this major recession.
well when we had our podcast 3 months ago, and we were talking about the numbers and how they were coming out, we were disappointed, right? Because we were like, the numbers didn't quite come back to what we're seeing in the trenches. No, what we're seeing, come across our actual reports, where volumes down, values are down, but still somehow inflation is up and unemployment's down, and it's like so interest rates went up and they eclipsed 7%, and so we're like, well, how does this make any sense? Because all of our numbers show that they should actually be going down because we are seeing companies with pretty shitty reportings and how can they sustain having paying all these salaries, etc. So we were disappointed with last quarter's numbers, and so I feel like the Fed and Congress and SEC and everybody was just behind on their numbers, and so surprise, surprise, the government is working 3 to 6 months behind, and they're trying to fabricate their own numbers. Because here's another thing that goes into it. I think that they're getting ready for the fact that there's an election year coming up, right? And so they wanted to hold off on essentially losing. This is just a theory.
Yeah.
This is just me thinking like, okay, we want to hold off as long as we can because we want to make voters extremely happy right before they vote. And so I think that there was a lot of, hey, look the other way on some of these numbers, and then we'll bake those actual numbers into Q3, which is what's happening, and then we can lower rates. We can do better on commodities. We can do better on grocery. We can do better on just overall cost of living. So just a few months prior to them walking into the voting booth, we can have them happier and be able to essentially swing some votes. So I think that there are some politics involved in it.
But what they didn't account for, though, this is what's interesting, and I agree with you, and I'd like to get.
I hope
Justin's,
not.
but
I hope it's
I
not
would
that
like
way.
to. I think it's always that way.
Yeah.
Yeah, I do.
But what they didn't take into account was the hit in the stock market and the S&P.
Yeah.
Because regardless of how great interest rates get, it doesn't look good.
Yeah.
Yeah, but I think that there's ways to manipulate that on a higher level. I mean, they have cronies over there, all these billionaires that are running these Fortune 500 companies saying,
Yeah.
"Hey, look, all right, what we're going to do is we're going to tank some stock over here for the S&P 500. That's going to bleed over into the Dow, and then it just becomes a domino effect because the media is controlling the narrative. And so, going back to your first point, as far as not seeing the real estate blowing up just because interest rates are better, I totally agree with that because the reality is that we were in a recession for about a year and a half. Like that's just what was happening. People were spending too much damn money during COVID.
They were still spending too much money
Right.
up until really recently.
Right, but then they gave, I feel, falsified inflation rates because I feel like people stopped spending as much money about a year ago, and so just now they're reporting it. I'm like,
And we were told there was going to be a bunch of lag on shelter costs, which we just finally saw that come through, where there was a big decrease in shelter costs, but unemployment went up dramatically. I mean, we're at 4.3%. That's an incredibly high number. I mean, I still feel like we were kind of going through this in just like such a short period of time during COVID, right before COVID, and things just blew up because of interest rates. I mean, people were on forbearance in their jobs. People lost their jobs, and it still blew up. I don't know if it. I don't feel like it. Did you guys see the article? It was June 18th, and maybe I should have brought this into one of our podcasts. Zillow wrote it on the shortage of homes in the United States, and it's actually up to 4.5 million homes short in the United States. Arizona being 94th, or Phoenix, Arizona being 94,000 of it. That right there, I don't feel like we're gonna see. I've been getting a lot of calls about recession. What is that going to do to the housing prices? And I'm just telling people it's supply and demand. One thing, rates are getting lower, so that means homes are more affordable. You got to consider that into your decision making. You got to have a place to live, and stocks are on clearance. Let's go.
Well, and that being said, most people equate a recession to every element of their life, housing included. So everyone's thinking, oh, okay, well, values are going down in real estate, and so good on them. I just see that there's going to be a huge opportunity in the financial world where I think there's going to be a lot more refinances coming down the pipe. A lot of people that had a 7 in front of their rate on a primary, they're going to be looking for that low 6, you know, and I think that that's smart of them because I mean, from the get-go, even when rates were up that high, you know. You even said it, you know, last month, you know, dating the rate, et cetera. But now it's time to stop dating that rate and start seeing what that looks. Even if you end up refinancing again in a year and a half because rates went down again, so what?
So what?
You know, that's just part of the
Don't lose
play
out
here.
on your opportunity if this is it.
All right, if you are looking for information on current rates where you sit as an investor or a home buyer, and more importantly, learning how to build wealth in real estate, we'd love to introduce you to one of our team members, one of our real estate wealth managers. All you got to do is text the word rates to 623-AZ-RECON. That's rates to 623-AZ-RECON. I think people just aren't asking the right questions. And I get it. You know, there's all types of different real estate buyers, sellers, and investors. And I guess, you know, the questions to me that a savvy real estate person asks themselves, it's not, are we in a recession? It's not what rates are at. It's not what unemployment's at. The biggest question you always have to ask yourself if you want to build wealth in real estate, Ryan, is where is the opportunity? Because regardless of what's happening, there's always opportunities. And if we get even, you know, because Amazon came out with an article or some comments the other day, they think that we're heading for a bigger recession because buyers are really slowing down on spending. Really starting, inflation's finally catching up with them. They're finally getting ticked off going to McDonald's and having to pay $18 for a Big Mac, you know, whatever. But people they're revolting. They've gotten caught up in the Olympics. They're getting caught up in the election coverage. They're just not spending. But there's opportunities everywhere, and I think that's the right question. And I think right now, as interest rates drop, we're not going to see a flood of buyers. I think there's an interesting opportunity.
Well, and I also for the past 2 years, CPI is suggesting that's what most people that are holding buy and holds like long-term rentals, they use CPI, Consumer Price Index, to determine whether or not they were going to increase rental rates, decrease rental rates, or keep them the same. And so this past quarter, we've finally started seeing a lot of property management companies do slight increases. And so we've talked about what the sine curve looks like and how it's usually on a 7 to 10 year cycle. It's the same over there on the rental rate side. So we're already seeing a slight rate increase on rentals because, like we've talked about before, when it's cheaper to rent than it is to own, who's going to be more stubborn, the landlord or the tenant? Right? And so now landlords are starting to get more stubborn because we are a lot more heavier on renters right now than we've been accustomed to in the past. And so simple supply and demand, right? So we are going to start seeing in the next couple of years rental price increases until there's either going to be another decrease on interest rates or lower cost of housing, or something's got to give, right? But I can promise you, being that that so many people have started to invest in real estate, even on a private side, like not these big, huge corporate rental companies, there's a lot of just regular old couples that own one or two different rental properties. They're going to start increasing the rates, and they're eating up a huge market share of that. And so tenants, get ready for it to be more expensive to rent and to own here in the near future. It's going to happen.
All right, well, opportunities come in all different shapes and sizes, and they're unique to each individual investor or buyer or seller. As a team of real estate wealth managers, this is what we specialize in taking a look at the economy, taking a look at the real estate market, adjusting, pivoting, and finding where those opportunities are. And we'd love to have an individual conversation with you, walk you through those opportunities, help you customize a plan to build wealth in real estate. But it starts by you texting the word RATES to 623AZ Recon. That's RATES to 623AZ Recon.